Alright, good afternoon ladies and gentlemen. My name is Ross Lucas Elliott. I'm a student in Professor Chatterjee's Finance 301 class. Today I'm going to be presenting a DuPont analysis that I've done over Johnson & Johnson, comparing it to the industry standard, which will be represented as UnitedHealth Group. So basically what we're going to be doing today is we're going to be utilizing the DuPont analysis method and analyze the following ratios: the liquidity, efficiency, profitability, market value, and leverage ratios. We'll be using a cross-section analysis from the years of 2013 through 2017 to do this, and all financials used for both companies have been taken from New York Stock Exchange and from Merchant Online. So just a brief introduction to Johnson & Johnson. They began in 1886 when Robert, James, and Edward, the three Johnson brothers, founded the company. They founded the company after attending a speech made by Joseph Lister in which he stressed the need for better care and better antiseptic in medicine, especially in surgeries, regarding bandages, cleaning equipment, things such as that. They absorbed many other companies throughout the years since then, producing many very well-known drugs, over-the-counter and prescription. As of today, Johnson & Johnson is made up of over 250 different companies and operates in 50-plus countries worldwide. They sell their products all over the world in over 170 countries, mostly they're selling to consumers. Consumer can range anywhere from a person buying Band-Aids at the store to a hospital that needs to buy medical equipment. So they have a pretty wide customer base. So we're going to go ahead and dive right into the analysis. The first thing we're going to be looking at is the liquidity ratios. We're going to focus on three different ratios in that particular section. That's going to be the current, quick, and cash ratio. So over the last 5 years, you can see an average for the current ratio for Johnson & Johnson of 2.123. So off the bat, you can also note that Johnson & Johnson has much higher numbers in this first ratio than UnitedHealth Group does. All these numbers are above 2.0 until we get to 2017, where we have 1.41. However, for UnitedHealth Group, all these numbers stay below about 0.8. With the closest we get to 0.8 would be 0.77. So the average for UnitedHealth Group for this period was current ratio of 0.732. So what this is going to tell us is basically that prospective shareholders are going to want a higher current ratio because it shows the company has more than enough cash and equivalents to cover its current liabilities. So what we're saying is that in a ratio, basically Johnson & Johnson has a ratio of 2.123 to 1. Saying that they have more than enough cash and equivalents to cover their current liabilities should they need to liquidate to pay those liabilities. So as we move on to the quick ratio, you can again see a pretty good difference in the 5-year average between UnitedHealth Group and Johnson & Johnson. So the highest point we see for the quick ratio for, the highest point we see in the quick ratio for Johnson & Johnson is going to be this 1.43 number, whereas UnitedHealth Group never gets above 0.57. So Johnson & Johnson again kind of declined through 2015, and then we see a little bit of an increase through 2016, but then again a decline in 2017 due to the change in presidential office. So the last one we're kind of going to focus on will be the cash ratio. So the cash ratio, basically, that's going to be the cash and its equivalents divided by the total current liabilities. So this is going to tell us that Johnson & Johnson has more than enough cash on its own just to pay off its liabilities. So whereas Johnson & Johnson averaged 1.207 for the cash ratio from 2013 through 2017, UnitedHealth Group only averaged 0.302, which is about 0.9 smaller than our average for Johnson & Johnson. So With a ratio of below 1.0, we can see that UnitedHealth Group would actually not have enough cash to cover all its liabilities should they have to liquidate. So despite this being an industry standard, it still proves to us that Johnson & Johnson works ahead of the curve and is in front of the industry standard as far as that goes. Just to kind of sum up what we just talked about with these liquidity ratios, based on UnitedHealth Group's liquidity ratio used as our industry standard, we can confidently say that Johnson & Johnson works well above industry standards with a current quick and cash ratio that are all much better and much further ahead than the ratios we see from our industry standard. So we're going to go ahead and move on now to efficiency ratios. So efficiency ratios measure how well companies utilize their assets to generate income. Basically, the easiest way to say this is that efficiency ratios should help to boost profitability ratios in the future. Managers within the company are looking to improve their efficiency, so they often use efficiency ratios to help make assessments about their profitability. So these ratios will definitely tie in to the ratios that we will be looking at later in this presentation. So we're going to go ahead and scroll down now and take a look at these efficiency ratios. So the first one that we're going to be looking at is the accounts receivable turnover. So accounts receivable turnover basically measures how many times a company will collect its receivables in a period. So in this example, a period would be 1 year. So Johnson & Johnson, you can tell, collects their receivables much less than UnitedHealth Group. Now, part of this is probably because UnitedHealth Group is more of an insurance provider and a healthcare maintainer. They have to get those premiums, they have to get payments. It's much more on a daily basis than just collecting sales, which is more of what Johnson & Johnson is known for. So if we look at the average, Johnson & Johnson had a 5-year average of collecting receivables about 6.09 times in the period. So their turnover rate would be 6.091, whereas UnitedHealth Group's turnover rate is 26.71, showing us that they collect receivables much more often, about 4 times as often. So as we move on, looking at the next ratio in this section, we're going to be looking at average collection. Now, as I mentioned, UnitedHealth Group is more of a healthcare provider, so that's why we see lack of ratios in these inventory-related areas. Now, in finding the financials for this project, UnitedHealth Group actually does not release inventory numbers on their financial statements. Merchant Online, Morningstar, New York Stock Exchange, there are no inventory numbers on these sites for UnitedHealth Group. So that is why there is a lack of ratios in these areas. So we're not really going to look at those, but we are going to go look at this average collection, which ties back to our accounts receivable turnover. So the average collection basically tells us, the average number of days in the year that go between times when Johnson & Johnson or UnitedHealth would be collecting their receivables. So we can see here that they average about 6.09 collections per year, and this translates down to our average collection, which is about every 60 days or so. With the lowest amount of time being 55 and the highest amount of time being 65. So when we look at UnitedHealth Group, we see obviously their accounts receivable turnover ratios are much higher, and they collect their receivables much more often down here, averaging receivable collections of about every 14 days or so. So now, while they could be collecting smaller numbers, that is why most investors don't really worry about this too much. They do want to see consistent collection. However, collecting your receivables less may mean that you will be collecting more at the time of collection. All right, so as we round out looking at average collection, it's clear that UnitedHealthcare gathers their receivables much more often than Johnson & Johnson does. However, as I previously stated, this isn't necessarily something that's going to worry us as investors. So last thing we're going to look at is total asset turnover. So as we go through the numbers in these 5 years, you already see the difference in UnitedHealth Group and Johnson & Johnson. For the 5 years, Johnson & Johnson averaged about 0.525 total asset turnover, while UnitedHealth Group only averaged about 0.110. So what this is telling us is basically that Johnson & Johnson is making 52 cents off of every dollar. So another way to say this is that investors and creditors use this ratio to assess, how a company uses its assets to generate revenue or sales. So in using their assets, the money they gain from doing that, they're going to be making about 52 cents off of every dollar. Now, 52 cents off every dollar may not seem a lot, but when you are a multi-billion-dollar company, those cents really do add up for you to get some big numbers. So to kind of round out the efficiency ratio section, we can definitely see the differences in accounts receivable turnover. UnitedHealth Group has a higher rate because they have an average collection that is much more often than it would be for Johnson & Johnson. However, despite all that, Johnson & Johnson is still making about 42 cents more per dollar when they use their assets in generating, revenues and things like that. We can confidently say that Johnson & Johnson is more efficient than our industry standard, even though they do not collect their receivables as often as UnitedHealth Group. So as we move down to the profitability ratios, we're going to be looking at the total profit margin ratio, the return on assets, and the return on equity. So the first one we're going to look at is the total profit margin. So total profit margin right here, you can already see some differences. UnitedHealth Group is down around 0.1 and below 0.1, whereas UnitedHealth Group is closer to 0.6, 0.65. So UnitedHealth Group averages a total profit margin of about 0.090, while Johnson & Johnson averages a total profit margin of about 0.688 or 0.69. So the total profit margin is going to be the total margin divided by the net sales. So for Johnson & Johnson, what this is telling us is that Johnson & Johnson still has about 68.8% of its net revenues that can be used to pay for other operating expenses and other company expenses after we compare it to the margin. So with 68.8% of its net revenue to pay for its operating expenses once the expenses of the inventory has been paid off. Now, once again, this ratio is going to be a little bit different for UnitedHealth Group as they do not have inventories, but it's still the same principle when comparing it to the margin. So next, as we move on to examining the return on assets ratio, return on total assets is going to be about 0.361 for Johnson & Johnson, whereas for UnitedHealth Group it's going to be about 0.019. Now, investors would rather see a little bit higher of a ratio here. This is a profitability ratio that measures the net income produced by the total assets during a particular period. So with an average of 0.361, this is basically telling us that for every dollar Johnson & Johnson invests in their assets, they get a return of 0.361, where comparatively UnitedHealth Group only gets a return of 0.019, pretty much 2 cents on the dollar. So the last thing we'll look at is the return on equity. So the return on equity for this period is going to be fairly low for both companies. And you actually see a little bit higher of a margin for UnitedHealth Group than you do for Johnson & Johnson. They're about 0.015 higher. Now, the way that we interpret the return on equity ratio, this ratio measures the ability of a firm to generate profits from shareholder investments. So with an average of 0.180, we basically say that investors see an average of 18% return on every dollar that they invest with Johnson & Johnson. Comparatively, investors in UnitedHealth Group would see a return of about 19.5% or 20%. So we're going to go ahead and wrap up this section about our profitability ratios. So just to look back, we took a look at the total profit margin, the total return on asset, and the return on equity, comparing Johnson & Johnson to our industry standard. So after doing so, we did see some downturn in return on equity for the 2017 period for Johnson & Johnson, which may leave some a little hesitant to invest in their stock, but I think that regardless of that, we can go ahead and say, confidently say that despite these recent downturns, J&J is more profitable than the industry standards that we are comparing it against. So we're going to go ahead and move on to leverage ratios. Now, leverage ratios are also known as solvency ratios, and they measure a company's ability to sustain operations indefinitely by comparing debt levels with equity, assets, and earnings. These ratios are often confused with profitability ratios. However, they are very different as they look more at the sustainability of the company rather than its current liabilities. Investors and creditors will use these ratios to evaluate a company's ability to pay off long-term liabilities to creditors, banks, and bondholders, all of which are places where a business could go if they needed to incur debt. So the three key leverage ratios we'll be looking at will be debt ratio, equity ratio, and debt to equity ratio. So first, we'll take a look at the debt-to-equity ratio. We'll go ahead and put this up on screen for you. First is our debt ratio. Now, the debt ratio can be seen at the top right here. They average, through the 5-year period, average about 0.5 for our debt ratio, while UnitedHealthcare averages about 0.64. Now, what this is going to tell us is it's going to tell us that for the 5-year period, J&J averaged a debt ratio of 0.499, which shows us that they average nearly twice as many assets as they do liabilities. So for the debt ratio, we are dividing total liabilities by total assets. So when you get a decimal that is less than 1, it means that your assets outweigh your liabilities, and in this case it would be 2 to 1. So as we compare this to UnitedHealthcare, we see that theirs is a bit higher, which means that a little bit less of everything they have is affected by these liabilities. So if we were going to have to pick between the two, obviously we would want to pick Johnson & Johnson. Just to highlight a few more things on this debt ratio, we see a high point in the debt ratio in 2017 for Johnson & Johnson. Now, this is also an impact of the legislation that's been pushed through by the Trump administration. This company incurred more debt in the 2017 period in order to be taxed at a lower rate with these upcoming tax cuts. So we see a high point for Johnson & Johnson in their debt ratio in 2017. However, the low point for UnitedHealthcare is 0.593, which is still not too far away from 0.618, and that is the lowest ratio that UnitedHealthcare has. So you can kind of see which one outweighs the other. Next, we're going to go ahead and take a look at the equity ratio. Now, the equity ratio is down here. First off, in 2013, we see Johnson & Johnson with an equity ratio of 0.67. As we move forward, we slowly see a trend in the positive direction until 2015. However, after 2015, we have a downturn as we fall from 0.703 to 0.699, and then further to 0.583. Now, the average equity ratio for that period for Johnson & Johnson was 0.669. UnitedHealthcare averaged 0.348 for our 5-year period, with the high point for them coming in 2013, where they had 0.393. Now, equity ratios tell us that, basically they tell us how much of a firm's assets are funded by the investors. So, of the assets that Johnson & Johnson currently has, about 0.669 of those assets are funded by the shareholders. Now, this is something that we want to see because it proves that shareholders fund more of the assets than debt does. And debt is something that can be dangerous for any company, no matter what the industry is, if they have too much. Now, as we look to compare it to UnitedHealth Group, we see that 0.348 is their equity ratio, meaning that meaning that about 0.348 of their assets are funded by the investors. Now, another thing this tells us is that the majority of their assets are funded by debt, which is not necessarily something that investors would like to see. So as we move on, last to look at the debt-to-equity ratio. The debt-to-equity ratio basically tells us the percentage of the company financing that comes from creditors to investors. So we're looking for this ratio to be fairly similar to our equity ratio. Now, as we look up here to debt-to-equity, we see how much in comparison. Now, Johnson & Johnson for our 5 years averaged about 0.755, while UnitedHealth Group averaged about 1.858. Now, once again, this ratio tells us the percentage of the company financing that comes from creditors and investors, not from, outside revenues or anything like that. So, about 75–76% of the company for Johnson & Johnson is funded through creditors and through investors and shareholders. When we look to the debt-to-equity ratio for UnitedHealth Group, their entire company and then some is funded by, basically funded by creditors and investors alike. Now, higher ratios mean that there is more creditor financing than investor financing. That is another reason that this ratio is so high for the UnitedHealth Group. And it's another reason that this ratio is lower for Johnson & Johnson, as we have more financing coming from investors. Now, to kind of sum this up a little bit just for, presentation purposes, we're pretty safe in saying, after comparing the leverage ratios of Johnson & Johnson against our industry standard of UnitedHealth Group, we can confidently say that Johnson & Johnson outperforms the industry standard in this category. So now we're going to go ahead and move on to our last set of ratios, the market value ratios. Now, market value ratios are used to compare company stock prices with other financial measurements, such as the earnings, dividend rates, and other things. Now, investors will use these ratios to help predict stock trends, to help figure out current stock values, but also to figure out the future stock values. Another way to describe market value ratios would be to say that market value ratios help investors see what they should expect to gain from their investment. They could receive earnings, dividends, or even appreciated stock values. Now, the three market value ratios we're going to touch on today will be the price-earnings ratio, the dividend yield ratio, and the sustainable growth rate. Now, we're going to go ahead and look at the price-to-earnings ratio first. So, if we take a look at price-to-earnings ratio, we see initially that the price-to-earnings ratio is a little bit higher, approximately 1.6 or so, 1.8. In favor of Johnson & Johnson. Now, when we look at this ratio, what we can decipher is that basically on average for our 5-year period, investors for Johnson & Johnson are willing to pay $17.21 for every dollar that they will earn on their investment. So if they're going to earn $5, then they're going to earn then they're willing to pay 17.21 times 5 just to earn that $5, if that makes sense. So as we go through this, we see a high point in this ratio in 2017, and we see a low point starting back here in 2013 for Johnson & Johnson. Now, as we look at UnitedHealth Group, we see that they start at about 10.8, and then they progress pretty quickly to 2015, where they're at 18.2. However, after 2015, we see a downturn where they fall to 17.82, and then further down to 16.77, with an average of 15.42 per period. So basically, once again, what this is telling us is that UnitedHealth Group's investors are willing to pay about $15.50 for every dollar that they're going to earn off of this stocks. So, as we next take a look at the dividend yield ratio. Now, dividend yield measures the amount of cash that dividends distribute to common shareholders. This is relative to the market value per share as well. In layman's terms, basically, it shows them whether their investments are going to generate the cash flows from dividends, or whether it will be via stock appropriation or however else they may get it. So, as we look at the dividend yield ratio, we see that Johnson & Johnson actually did not release numbers pertaining to dividends in 2013, so that's a calculation we're unable to make. However, as we move forward, we see that the dividend yield starts at about 1.77 in 2014, and it slowly rises into 2015. However, after 2015, it falls down back to 1.177, and then even further to 0.159 in 2017. Now, we can again attribute this drop again to the change in legislation due to the Trump administration in preparation for oncoming tax cuts. Now, Johnson & Johnson averages about 0.173 dividend yield for the 5-year period, where UnitedHealthcare averages about 0.122. So basically, that average 5-year ratio of 0.173 is going to translate to a yield of about 17 cents off of every dollar that investors will invest. Investors want to see a higher dividend yield ratio. However, this does vary greatly by industry. The tech industry has very, very low dividends, and healthcare is a different industry. However, Johnson & Johnson is a healthcare tech company producing products and computerized things. So that is one reason that we might see such a low dividend yield. However, if you are investing $100,000 or more, that 17 cents per dollar can add up pretty quickly. As we compare that to UnitedHealth Group, they earn about 12 cents off of every dollar that is invested. So the last thing to move on will be sustainable growth rate. Now, sustainable growth rate is used to help make sure that companies do not overextend their financial resources and liabilities. Johnson & Johnson starts in 2013 with a sustainable growth rate of about 9.5%. They translate upwards into 2014, however, severely dropped down here into 2015 by about 1.6. As we move from that into 2016, we see a little bit of a rise. However, this is when we can really see where Johnson & Johnson is trying to take these losses and cut their profits in order to get these tax cuts. Is they have a sustainable growth rate that is not only low at 0.117, but it's a negative 0.117, meaning that they experienced negative growth in that period. So in the next period, they're going to have to get that growth rate up in order to retain all their investors and retain rates that are favorable. For the period, the 5-year period, they average about 6% growth rate. However, if you take out this severe outlier of negative 0.117, we see that it increases. Now, this increase can be, it increases to about 10.7 instead of, 0.062 if we take out this outlier right here in the data. So now comparing to UnitedHealth Group, they start at about 14.5% sustainable growth rate in 2013, which is a very nice rate. They fall a little bit all the way into 2015. However, they start back on the rise in 2016, and in 2018 we see a high point in the 5 years with an 18.3% growth rate. Now, the average growth rate for the 5-year period, sustainable growth rate, was 0.144, about 14.5%. So that's something that investors do like to see is a little bit more consistency. And when investors see an outlier, that's not necessarily something that they want to encounter. So this can put up a little bit of a red flag for Johnson & Johnson. Now, to kind of sum up these market value ratios, either way you spin it, J&J is a little bit behind the curve as far as their sustainable growth rate goes. However, for these market value ratios, we see that Johnson & Johnson does excel past our standard in 2 of the 3 ratios that we have examined. So, because of that, we can still confidently say that while Johnson & Johnson may be a little bit behind in their sustainable growth rate, they still have a very solid market value in comparison to industry standards, and are still definitely worth the time and money that you will invest into them when you do so. So we're going to go ahead and kind of wrap up this presentation and conclude with a little bit of going back through what we've looked at and just kind of giving a quick recap. We've compared Johnson & Johnson to the industry standard represented by UnitedHealth Group. We have compared the profitability ratios, the liquidity ratios, the efficiency, the market value, and the leverage ratios for both companies. Now, what we have found is that through this analysis, Johnson & Johnson is more liquid and more profitable than our industry standard. We also see a difference in efficiencies and market values with J&J just kind of slightly outdoing the competition. In market values, they were 2 out of 3, and so they do slightly edge past our industry standards in those 2 areas. But the leverage ratios are really what helps us to be confident in Johnson & Johnson's ability to outperform the industry standard. They have placed much more value in shareholder financing rather than financing through debt and creditors. And so, all things considered, it would definitely be worth seeing where Johnson & Johnson goes in 2018 because they did have several drops in ratios for the 2017 period. Despite that, though, I am very much confident to say that investors could rely on Johnson & Johnson not only to perform above the industry standards, but to bring them solid returns. If you evaluate the data, I feel that you will come to the same conclusion. And so with that, I want to say thank you for your time. Thank you for attending this presentation. And I just want to wish you a happy rest of 2018 and a Merry Christmas. Thank you.